Have you ever stopped to think about how a decision made in some fancy boardroom in Washington, D.C. can actually affect the mortgage you pay on your house? Or, even the coffee you just bought using an app on your phone? Well, today, we're going to connect those dots. We're diving into the Fed, the SAFE Act, and the world of FinTech to see how they all lead right back to one place, your wallet.
So, really, what is that invisible thread tying together the entire U.S. economy, the biggest loan you'll ever get, and the phone that's probably in your pocket right now? Stick with me, because by the time we're done here, you are going to see exactly how it's all connected.
All right, first up, let's tackle the big one, the Federal Reserve. You've heard them called the Fed. The easiest way to think about them, they're like the entire economy's thermostat. They don't create the financial weather, but boy, do they have some powerful tools to try and keep the temperature from getting too hot or too cold. Now, the main job of the Fed, their whole reason for being, is something called monetary policy. That sounds super complicated, but all it really means is managing the country's supply of money and credit. Their goal? To keep the economy humming along, stable and growing. So how do they actually, turn that thermostat dial up or down? Well, their first tool is the reserve requirement. It's basically the percentage of cash that a bank has to keep in its vault. It's not allowed to lend that chunk out. So if the Fed raises that percentage, banks have less money to loan out, and that naturally slows the economy down. If they lower it, suddenly banks have more cash to lend, and that can really speed things up. The second tool is one you've definitely heard about, interest rates. The Fed can change these key rates, like something called the discount rate, which is what it charges banks for short-term loans. You can guess what happens next, right? Lower rates make it cheaper to borrow, so banks, and you, are more likely to take out loans and spend. Higher rates do the exact opposite. It's a really powerful way to get people to either open their wallets or keep them closed. And their third tool, which is actually the one they use most often, is called open market operations. It's just a fancy term for the Fed buying and selling government securities, like bonds. When the Fed buys bonds from banks, it's literally injecting cash into the banking system. When it sells them, it's pulling money out. Simple as that.
So it really all boils down to two basic moves. If they want to heat up the economy, that's called expansionary policy. The Fed buys bonds and lowers interest rates. If things are getting too hot and they need to cool it down, that's contractionary policy. They do the reverse. It's this constant, delicate balancing act to keep everything running smoothly.
Okay, so the Fed is managing the big picture, the whole economic climate. But how does that system actually protect you when you're making the biggest purchase of your life? To get that, we have to zoom in from the economy's thermostat all the way to your front door and talk about a rule book that was born from a crisis that changed mortgages forever. Let's rewind to 2008. The financial crisis hits, and it just rips the cover off of massive problems and fraud in the mortgage industry. So in direct response to that chaos, Congress passed the SAFE Act. And listen, this wasn't some polite suggestion. It was a total overhaul of the system, designed to make sure that kind of meltdown could never happen again. And the goal of the SAFE Act was crystal clear. It was written right into the law to enhance consumer protection and reduce fraud. At the end of the day, this was all about creating a trustworthy, transparent process for the single biggest financial decision most of us will ever make. So how'd they do it? The SAFE Act created one single national set of standards for anybody who wants to originate a mortgage. And these weren't small things. We're talking mandatory education, passing a really tough national exam, and getting full background and credit checks. Everyone even gets a unique ID number so they can be tracked nationally. It basically professionalized an entire industry, all to protect you, the consumer. Okay, so we've got the Fed setting the economic climate, and we've got the SAFE Act writing the rulebook for mortgages. It's a pretty stable, regulated system, right? But what happens when a new technology comes along that can just move way faster than any of the rulemakers? Well, that, my friends, is the story of FinTech. At its heart, FinTech is really just technology that improves financial services. But there's a reason it's often called disruptive technology. It's not about making tiny little improvements here and there. It's about fundamentally forcing the old school players, like traditional banks, to completely change how they do business just to have a chance at keeping up. I mean, think about the old way, right? Physically going into a bank branch, waiting in a long line, filling out what felt like mountains of paperwork. Yeah, the FinTech revolution just blew all of that up. Now, you can apply for a massive loan on your phone, you can send money to a friend instantly, and you can manage your entire financial life from an app wherever you are, whenever you want.
And look, this isn't some science fiction, far-off future. You are living in it right now. E-wallets like Apple Pay and Google Pay, payment platforms like PayPal, your bank's mobile app, heck, even online mortgage lenders. These things aren't just cool conveniences anymore. They are a normal part of how we all deal with our money every single day.
So let's bring this all back home. We've talked about the big picture controllers and the official rule makers. But with this powerful new technology on the rise, what does it actually mean for you and for your wallet? Just to give you a sense of the scale we're talking about, look at this number. That's not how much a company's worth. That is the amount of money, $315 million, that just one fintech company, PayPal, processes in transactions every single day. That is an absolutely staggering amount of economic activity, and it's happening almost entirely outside the traditional banking system.
So what's the upside for us? Well, the benefits are huge. We are talking about way faster service, lower costs because technology is doing a lot of the heavy lifting, and in many cases, even better security for our money. And that leaves us with one final, really important question. We know the Fed sets the economic temperature, and we know the SAFE Act wrote the rulebook after the last crisis. But as fintech makes money move faster and in ways that we have never seen before, who's going to be responsible for writing the next rulebook?